So today, we're going to tackle an idea that didn't just make investor George Soros billions of dollars. It pretty much tore up the rule book on how markets are supposed to work. It's a concept he called reflexivity, and it suggests that our beliefs don't just predict the market's future, they literally create it.
At the very heart of finance, there's this massive disagreement. The traditional textbook view says the market is like a mirror, right? It just passively and rationally reflects a company's real value. But Soros comes along and says, no. The market is more like an engine. It doesn't just reflect reality, it actively changes it. And that's the core battle of ideas we're going to dive into.
And the guy who championed this pretty wild idea was, of course, George Soros. He didn't just kind of disagree with the conventional wisdom. He built an absolutely legendary career by betting billions on the simple fact that markets can be profoundly and, well, profitably wrong.
All right, so here's how we're going to break this all down. First, we'll challenge that old idea of a rational market. Then, we'll get into the engine of his whole theory, the reflexivity loop. From there, we'll see how that loop creates these huge boom and bust cycles. Check out how Soros used the real world as his own lab. And finally, we'll wrap up with what this new way of seeing means for all of us.
Okay, part one, markets aren't mirrors. Before we can really get Soros's big idea, we first have to understand the problem he had with the standard theory of a perfectly rational market. For decades, the main theory treated economics almost like it was physics. It just assumed that all investors were these perfectly rational computers, all working with the same info, and that the market was this tidy, self-correcting system always trying to find a stable balance, or equilibrium. A neat picture, for sure, but as Soros argued, a deeply, deeply flawed one. But Soros came in and asked a really disruptive question. What if we're not just impartial observers watching from the sidelines? What if our very human feelings, our biases, our hopes, our fears, actually change the rules of the game while we're playing it? And that question is right where his theory of reflexivity kicks off. Which brings us to section 2, the reflexivity loop. So if our beliefs actually change reality, how does that really work? Well, Soros's answer is this powerful feedback mechanism that's at the very core of his philosophy.
So what is reflexivity exactly? Think of it like a two-way street, a feedback loop. It starts with our perceptions, what we as investors think and feel, and that pushes prices up or down. But, and this is the key part, those new prices then go on to change the real world. A sky-high stock price can help a company get a cheap loan. A falling one can damage its ability to do business. This new reality then feeds back and reinforces our original belief, creating this powerful self-fueling cycle.
Let's just walk through this loop in action. It often kicks off with some kind of shared bias. Let's say a ton of optimism about a new tech. That hype drives up the company's stock price. Then that higher price makes it way easier for the company to raise money and hire the best people, which, surprise, surprise, actually improves its business fundamentals. And those better fundamentals then look like they justify the initial hype, which reinforces the bias and sends prices even higher. You can see how the loop just feeds on itself.
And as you can imagine, these self-feeding loops can lead to some pretty dramatic consequences. In Section 3, we're going to look at the anatomy of boom and bust, because when these reflexive cycles get going, things can get, well, pretty chaotic.
Think about it. If reflexivity is real, you can just throw that whole idea of a stable, balanced market right out the window. Instead, Soros says markets are fundamentally unstable. They're always prone to these wild excesses, these euphoric booms and these gut-wrenching busts. It's not a bug, it's a feature. It's just part of the market's DNA.
And Soros saw a pretty predictable pattern in all this. A boom gets going when a trend starts building on itself. Then it hits this temporary peak, a point where the bubble feels totally normal, even justified. But sooner or later, that gap between what people believe and what's actually real gets too wide. One little thing can shatter the whole illusion, reverse that feedback loop, and trigger a catastrophic collapse.
So what's the rocket fuel for these cycles? One word: credit. Soros said that credit isn't some neutral, boring tool. It's an accelerant. When credit is easy to get, it's like pouring gasoline on the fire of a boom, supercharging that feedback loop. And when that credit suddenly dries up, it starves the market of oxygen, making the inevitable crash that much worse.
But look, this was never just some abstract theory for Soros. In Section 4, we'll see how he put his money where his mind was, using the real world as his own personal market lab.
In his incredible book, The Alchemy of Finance, Soros did something almost unheard of for a big-time investor. He actually showed his work. He published his personal trading diary, showing in real time how he was using this theory to place massive bets on everything from currencies to stocks.
He literally treated the market like his own experimental laboratory. And the title of his book, The Alchemy of Finance, is so important here. Like an old alchemist, Soros believed you didn't need one perfect theory. Instead, success came from constantly forming a hypothesis, testing it out in the real world, and, this is the most important part, having the humility to admit when you were wrong and pivot fast.
So what does this all mean for us? Let's bring it all together in our final section and distill Soros' theory into a new way of seeing not just the market, but the world.
When you boil it all down, reflexivity gives you a completely new edge. It teaches us to just accept that markets are biased and they're unstable. It forces us to see prices not as a passive scoreboard, but as an active player that's shaping the game. It tells us that boom-bust cycles are just part of how things work. And maybe most of all, it proves that real success requires constant change and adaptation, not just sticking to one rigid belief. But you know, this is so much bigger than just an investment book. Reflexivity is a powerful mental model you can apply to almost any complex system where people are involved. From politics to fashion trends, you name it. It's a tool for thinking about a world that is messy, unpredictable, and always being shaped by what we believe.
And that leaves us with one final, pretty provocative thought. If Soros is right, if our collective beliefs and biases really do shape our economic reality, then we have to ask ourselves a pretty serious question. What kind of reality are we all creating? Right now, today. Thanks for joining this explainer.